following program is sponsored by Adams Financial Concepts. Welcome to About Money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth and has a proven track record of managing long-term investments, surpassing the markets in the long term. The information shared in the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
It's Saturday, and we're talking about the answer about money. So are you worried about running out of money? A lot of people have that issue. A lot of people are concerned. If you are one of those, you're not alone. You've got a lot of other people that feel the same way. And in that respect, do you feel the advice you're getting is really good advice, or it's not good enough? You would really prefer great advice. You know, we're going to talk about those things today in this program. We're going to talk about that. But I want to start with a study. It's about money and about chance. And investment is never a positive, certain, you can count on the final result. So this game was set up. Every player was given $20. They were going to play $1 per play, 20 plays. Sounds straight. $20, 20 plays, $1 per play. And each round, they were going to invest $1, and if a coin came down heads, they got $2.50 back for their dollar bet. Every time the coin came down tails, they lost their $1. And they could quit at any time. They could just take their $20 and walk away. Or they could play the game. And so 100% knew that the idea was, it was a study, they were going to do it. So think about it. Think about how you would feel. Imagine yourself sitting there, $21 bills laying in front of you. You put the first dollar out, and you wait for the coin flip. You sit and you wait. The coin is flipped. It's in the air. It comes down, and it's heads. They take your dollar, and they give you $2.50. So now you have $21.50. You just won. You're $1.50 ahead. So you take another of your dollars, and you put it out there. The flip happens. It's in the air. It comes down, and it's tails. Your dollar is taken off the board. It goes away. You're still ahead 50 cents, right? So will you play again? You know, you're ahead 50 cents. Will you play again? Well, if you look mathematically at what's going on, you should play every single time, because you have a 50-50 chance of getting back $2.50 and losing $1. The net gain is $1.50. You should play the game every single time. And if you have, in those 20 plays, 10 heads, 10 tails, you come out ahead with $25. You know, but it probably won't always be 10 heads, 10 tails. It's going to be more heads than tails, or more tails than heads. But if you look at the thing from a mathematical standpoint, 87% of the time, if you play that game, 87% of the time, you're going to come out with your $20 or more. Only 13% of the time will you come out with less than $20. So that game has been played. And it was a study that was done. They did that game over a large number of people. And what they found is, in a normal group, they invested less than 40% of the time. Every time there was a tail that came up, some people would drop out. And it got worse as time went on. 70% had dropped out by the end of 5 rounds. 70%. And fewer than 50% made it all the way. Of course, if 70% dropped out after 5 rounds, of course, less than 50% would make it to the end. It doesn't take rocket scientist to figure that out, huh? So the best thing to do is to play the whole thing. But investors, like those people in the studies, have a tendency not to like to lose money. Even today, with the markets up threefold, there are people that are still concerned about losing money. It's normal for a lot of people to hate to lose money. And financial advisors and brokerage firms know that. So if you had a financial advisor, do you believe he'd say you should continue to invest? 80% of the time you're going to make money and 13% of the time you're going to lose? You know, that's the way things are in question. They truly are in question. And what that means is that portfolios are structured in such a way as to theoretically reduce risk or reduce volatility. Reduce that fact that you're going to lose money at any given time. That's the way portfolios are normally set up by most financial advisors. That's called asset allocation. The idea of that is to reduce those times when you're down, when you lose money. It's to reduce the times when you come up tails instead of heads. So keep that in mind, because I want to talk about something that happened in September 1951. September 1951, it was the second year of the Korean War. And during that time, there was a Korean junk boat, a junk, you know, those little boats that came through. That boat was filled with a mess of bodies. There were 19 young boys. They were bloody, they were bleeding, broken arms, broken legs. They'd been caught in an ambush during the war, and they were in a mess. And that boat pulled up alongside a Royal Canadian Navy ship called the Cuyahoga. And there was a Dr. Joseph Sear, a surgeon lieutenant, who pulled out his kit and began to work. There was only one problem. Dr. Sear didn't hold a medical degree, and in fact, he'd never even graduated from high school. Nevertheless, he went to work, and 48 hours later, he had performed all those surgeries that saved all 19 of those young men. All of whom, every one of those young men, 19, would have died without him. But not only was he not only qualified, all he had was a medical textbook that he had borrowed from a real doctor. That's what he was working with to perform all those surgeries. That and his confidence in his own abilities. And that news, that information made the news, and he became pretty famous all about that. And it turned out that his real name was not Joseph Sear. It was Ferdinand Waldo Damara. And not only had he pretended to be a doctor, in previous times he had pretended and impersonated and sold himself as a professor, as a psychologist, as a monk several times, as the founder of a religious college, and many, many other professions. It wasn't that he was good looking. He was 6'1" and 250 pounds. It was just that he had the ability to come across as the great imposter. And there would be a book written about him called The Great Imposter. Maria Konnikova wrote the book called The Confidence Game. It's one of the oldest stories ever, she says. It's a story of belief. A belief about basic, irresistible, universal human need to believe in something. And she points out, and I quote, "In some ways, confidence artists like Damara have it easy because we've done most of the work for them. We want to believe what they're telling us. Their genius actually lies in figuring out what precisely it is that we want and how they can present themselves as the perfect vehicle for delivering on that desire." Let me repeat that. In some ways, confidence artists like Damara have it easy. We've done most of the work for them. We want to believe in what they're telling us. Their genius lies in figuring out what precisely it is we want and how they can present themselves as the perfect vehicle for delivering on that desire. You know, I spent 18 years working for the big brokerage firms, and their instructions as we went along were sell the relationship, not the performance. The reason they don't want you to sell the performance is because they underperform. They don't really deliver for their clients. But they understand what you want to believe. They understand that, and they have their own genius in figuring out that precisely what you want and how they can present themselves as the perfect vehicle to deliver on that desire. They don't tell us how much money we're going to have in 10 or 20 or 30 years. They want to assure you that you're not going to lose very much money. That's the whole thing. You know, they're the ones that will tell you past performance is no guarantee of future performance. The question is, how do you explain the Buffetts and the Prices, the Templetons and the Lynches, those guys that delivered extremely good returns? Those are investment managers that when they were managing delivered very high returns. We're coming up to a commercial break. Don't go away, because we want to finish this up. How does all this apply to you? I'll be right back.
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So I've been talking about the confidence game that most financial investors live in. Eugene Fama shared the Nobel Prize in 2013 when he showed that 7% of professional financial managers, fewer than 7%, those that run mutual funds, those that manage separate managed accounts, those that run hedge funds, fewer than 7% do as well as the benchmark when you figure in their fees. Now, that doesn't include any financial advisors. Financial advisors will get you invested with those people, but given the fact that 93% underperform, that means that a lot of financial advisors are invested in people that underperform. One of the classic books written was a book called A Random Walk Down Wall Street, written by Burton McKeel. Back in 1987, when I was a new stockbroker, I read the book and I called him. And he said the stock market is a random market. Stock price movements are completely random. The monkey can take darts and throw it at the Wall Street Journal, pick out the stocks by throwing darts, and perform as well as anyone else. So, given all that, and the random walk down Wall Street, in which essentially he's saying the same thing in 400 pages, given that, I called him up and I said, okay, so how do you explain Buffett and Templeton and Price and Lynch? And his response was, yes, some do better than the market, but most don't. Most don't. And in fact, he runs a fund and he sells the point that it's a random walk down Wall Street and you shouldn't expect to do as well as the market. Like Dr. Sear Damara, financial advisors and their firms have figured out what it is precisely that you, the investor, wants. And like the game, they want you to believe that every financial advisor is the same and that when the computer spits out, what that spits out is best for you. They figured out the financial plans they give you, and they want you to believe that you have a plan that's going to get you through the rest of your life and meet all your financial obligations. And they even color it with Monte Carlo simulations so that they can say, these are the percentages that you're going to make it. These are the percentages you're not going to make it. And let's Let's tweak a few things so we reduce the percentage that you're not going to make it. And they pick those financial advisors that have a great bedside manner, and people go into those financial advisors and believe what they say. But what they don't tell you is this: Monte Carlo simulation doesn't work in reality. There are thousands of investors who believed their plans would get them completely through that got a complete shock in the Great Recession when they found out that their portfolios had drastically reduced in value. That was not supposed to happen. And Monte Carlo simulation said the probability of that happening was extremely low. The fact is, it's not as low as the Monte Carlo simulation said it was going to be. Some of their children that the parents had financial plans, some of the children couldn't attend the colleges they wanted to go to because they no longer had educational funds that they needed to go to those colleges. Some pre-retirees had to work longer because they didn't have enough money to retire when they intended to retire. And some retirees had to reduce their expenses because their nest eggs were reduced during that time. I would guess, as a listener, most of you have a financial plan. Did your financial advisor tell you that it doesn't always work? Did they tell you that lots of these plans actually failed during the Great Recession? Do they tell you that when you have a financial plan and when you do asset allocation, that you're giving up a significant potential increase in your nest egg? When you have asset allocation, if you have stocks that are returning 9%, bonds at 5%, and cash at 1%, when you average all that together, you're going to get a 5% return. If you're completely invested in stocks, you're going to get a 9% return. What's the impact of that? The impact is very significant. Over 10 years, you'll have $156,000 instead of $235,000. Over 20 years, you'll have $250,000 instead of $611,000. But do they tell you that? I don't think they tell you that. They don't want you really to know. They want to address the idea that you're getting a financial plan that's going to get you through. Listen again to how Konnikova described the con men. In some ways, confidence artists like Damara have it easy. We've done most of the work for them. We want to believe in what they're telling us. We want to believe in what they're telling us. Their genius lies in figuring out what precisely it is we want and how they can present themselves as the perfect vehicle for delivering that desire. That really bothers me. And I see many clients or prospects that come to me, become clients. We do only three things at Adams Financial Concepts. We keep it specialized. That's our focus. The first thing we do is 401ks. Our focus is on the return on investment and the return of the company's return on investments. We prepare the employees for retirement, and we want to grow their accounts. The second thing we do is we work with individuals who have between $100,000 and $999,000. We want their portfolios to grow or to produce a sufficient income to get them through. My passion, and I say it on my website, my passion is to create wealth for my clients. If you look at the portfolios that most financial advisors are producing, they're producing not wealth. They're producing good results, but they're not producing great results. There's a reason why they don't publish their returns, a very good reason why they don't publish, because they don't want you to know what the real returns are. I say in the documents we sign that my goal is to beat the Standard & Poor's 500. And if you look at the results I've produced, the average account is doing that or close to it. That's for investors who have between $100,000 and $999,000. For accredited investors, and the regulations set up specific criteria for accredited investors. investors can actually have an account where you share in the profits, and we do. You have to have a net worth of $1 million or more, a net investable assets of $1 million or more, and a net income in the last 2 years of $300,000 or more. And in those accounts, we actually do a long-short portfolio. We do 150% long, 70% short, with a net exposure of 80%. And maybe you're not familiar with that. If you're an accredited investor, maybe you are familiar. It produces lower volatility and higher performance. If I could, I would do it for everyone. But regulators restrict it to accredited investors, primarily because they believe that these can be higher risk. I believe that they're probably lower risk. But for those accounts that have $100 to $1 million, we produce very, very good results, and we post those results. My passion is to create wealth for each and every one of my clients. The proof is in the pudding, as the expression goes, and my performance is published. I'm excited, frankly, that my numbers for the first half of 2019, we haven't seen them yet. The way that we get our numbers is my clients' portfolios are at Interactive Brokers. We've hired Morningstar to go in and collect that information directly from Morningstar. They then compute the returns for each client. And then that information is compiled into a composite showing how the average client or the composite of my clients do. It's third party. It's not individually done. It's third party. But my gut feel is that we've had a very, very good first half. And I'm looking forward to a solid second half as well. That is where we're at. You know, in looking at this whole thing, there's a common theme that more volatility comes with more risk. That the bigger the return, the greater the risk. Especially with a Great Recession, that whole idea of reducing risk has become a big byword. You know, I have a feeling that that's not the whole story. If you look at a portfolio made up of treasury bills or stocks, the normal feeling is that a treasury bill portfolio will have less risk than a stock portfolio. And I believe that that's all true in the very short term. If you need that money in the next year or next 2 years, the treasury portfolio is going to be safer and less volatile. However, if you look at it over 25 years, if you look at a portfolio of treasury bills that are paying 2%, 3%, over 25 years, that portfolio is going to produce $222,000 for $100,000 invested. That same portfolio in stocks is going to produce $862,000. Now you tell me, which is riskier, 222 or 862? And if you take 3% inflation, the treasury bill probably doesn't even keep up with inflation. You end up with only as much or maybe less in a treasury bill account as you have started with. I believe you really have to focus on defining what risk is and what returns are. It's a myth of what is. We're going to come right back after this, and I want to talk about one of the other areas which financial advisors are keen to do because they get paid a lot. I'll be right back after the break.
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So, I want to go on. I've been talking almost this whole hour. I'm going to talk this whole hour because we don't have a guest today, but I wanted to take this time to go over some of these things which I've been thinking about that are sitting in the back of my mind that I seldom get a chance to talk about. They're some of the big big concepts that are involved. And safety, safe money is one of those which we hear a lot about, from asset allocation to diversification to the types of investments, treasury bills versus stocks, etc. One of the assets, one of the investments that people have strongly recommended during these times, especially to baby boomers that are reaching the end of their earning career, are annuities. You've probably seen the ads on CNBC. I'd rather die than sell someone an annuity. I'm not quite that long. I don't have an insurance license. I had one. I let it drop because there are very, very few people that need an annuity. Most people who are sold the annuity are not people who should have an annuity. Helen Olin was a columnist, nationally syndicated columnist, who wrote money columns about money. And she wrote a book called Pound Foolish, exposing the dark side of the finance industry. And she said there's two things about annuities. The first is that they're increasingly sold to baby boomers worried about running out of money. You remember I started the program saying, are you worried about running out of money? Annuities are sold more and more to baby boomers who are worried about running out of money. And the second thing she said is they're so complicated, so difficult to understand, there's so many financial penalties that they're only sold for one reason and only one reason, and that's because they make a lot of money for financial advisors. Rarely is it in the real interest of the client. Yeah, there are a few, but rarely is it in the real interest of a client to have an annuity. You know, there was a study done, and if I mispronounce the name, he's a professor at Harvard, Sendail Matatron, I think is how you say the name, but he devised sample portfolios which had glaring, obvious mistakes in the portfolios. And he sent actors to take these portfolios to financial advisors and see what the financial advisors would do. And he said after the actors returned with their recommendations from the financial advisors, what the advisors had recommended was not illegal. It wasn't illegal behavior, but it was malfeasant. When one of these actors pretending to be a client came in and they had something that was obviously very glaringly wrong, there was not a single financial advisor that actually corrected an incorrect investment bias. The financial advisors figured out what those supposed investors wanted, and they presented themselves as financial advisors as the perfect vehicle to achieve the goals those actors wanted to achieve. They didn't know they were actors. Those actors had wrong opinions. They were shown to be wrong, but the financial advisors didn't correct them. When I went through training when I first went with Payne Weber. We used to study for the Series 7 exam. We went off, if we passed the Series 7, we went to San Mateo to a training center where we spent 2 weeks primarily cold calling, learning how to cold call. Then back to the Seattle office for 2 weeks to actually do some real cold calling. Then back to San Mateo for 2 more weeks while people listened to our phone calls. Then back to Seattle for 2 weeks. Then down to San Mateo. 6 weeks in total in San Mateo. And mixed in with most of that cold calling, there were probably 2 or 3 hours per day when we talked about training on sales practices, on investments, a very little bit of it on investments, probably less than 10 hours out of 3 weeks, 6 weeks. Anyway, one of the things that they taught us was, suppose somebody calls up and they say, what do you think about IBM? The right answer for that is to ask, are you a buyer or a seller? It's not this is what I think about the stock. This is what I think is going to happen. The answer we were trained to give was, are you a buyer or a seller? And then when you knew if the person calling up was a buyer, everything was great. If they were a seller, you gave them all the reasons why they should sell the stock. You just simply found yourself becoming the perfect vehicle to do and reinforce what the caller really believed. You know, but in that whole process where they did that study, sending actors in to pretend that they were investors and wanting to get opinions, 70% of the actors came away feeling so good with meeting with those financial advisors. They were so personable. They had sold the relationship so well that 70% of those actors wanted to go back and do work with those financial advisors. You know, I have to say, my approach is such that if somebody comes with a portfolio, I'm going to take the portfolio completely apart because I do my own thing. I've had a lot of success in my 30 years of performance, and I'm going to build a portfolio that meets the client's risk and objectives and make that portfolio work over the long run. But one thing that happened in those studies and happens frequently is financial advisors will propose an annuity, and especially for a baby boomer who's getting close to retirement, someone who's worried about running out of money. The fact is, there's one person and only one person who is really a beneficiary of an annuity, and that's the financial advisors. Financial advisors are getting paid somewhere as much as 14%. Usually it's somewhere between 8 and 10%. Annuities paying 6 or 7%, financial advisors getting 8 to 14%. You can read the insurance companies' bottom lines and how they're performing. They're not losing money. So if they're paying 6% to you and they're paying 8% to the financial advisor in a one-time deal, where's the money coming from? You know, you have to read the fine print, and they're making a lot of money from what you're doing. The annuities are very, very complicated, and they're not investing in fixed assets that are the same as they're giving to you. They're investing in other things. You know, there's no such thing as a free lunch. Annuities, in general, are sold either in one-to-one settings or they're set up as free seminars. You've probably gotten some of those in the mail. If you're in the right neighborhood or if you're in the right business, you've probably received an invitation to a free seminar. It's almost exactly the same pattern. The SEC and FINRA have said that over half of the flyers are misleading. Claims that they're low risk. That's misleading. It's claimed that 9% of the people who attend will buy annuities. And actually, that is a true fact. 9% do. The whole focus of it is based on creating fear. And the pattern is scripted. It's the same. They use fear. The idea is to make the attendees sweat a little. They pose a problem. At the same time, the annuity is the actual solution. But they don't use the word the annuity. They pose a problem, and they want to press the hot button. Will your retirement survive the economic meltdown? We've been through an economic meltdown. Will it survive the economic meltdown? It's one that will have about 20 to 30 slides. Social Security is uncertain. It may be taxed up to 85%. Health costs are rising. 47% of Americans are going to run out of funds if they retire at age 65. Are you one of the 47%? There's nothing to fear if you plan for it, of course. Then the sales pitch for the annuities come. And seniors are the target group. 20% have inappropriate investments or pay significantly higher fees. They're guaranteed never to go broke, the insurance companies. They don't tell you that Executive Life, the largest in California, did go broke in 1991. State took it over. First Capital Life sold junk bonds. They went broke. Mutual Benefit Life was a huge shock because it was conservatively invested in blue chips and solid companies. A-plus rating, it went broke. Payments, when a company goes broke, are frozen, and they begin to pay out, but they pay out at a lower rate. Baldwin United went broke in 1987. The payments were delayed for 4 years, and then only 1 or 2% per year. Anyway, we're coming up to a commercial break. That's just one of the issues with annuities. They're sold on the basis of fear. There's a lot to take forward out of this. Fear is the only thing we have to fear itself. Be right back. Don't go away.
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So I was talking about annuities. Annuities are what I call chocolate-covered hand grenades. They sound so good. They sound like they're gonna solve all your issues. They're going to guarantee income for the rest of your life. You don't have to ever worry. Things are going to be awesome and great. Chocolate-covered hand grenades. Believe me, if we have a downturn like we did in the Great Recession, some of those annuities are going to go bye. Not continue, but bye. That happens. But I want to shift a little bit and ask you the question. If you got a letter, and if you've been listening for a long time, you've probably heard this before, but if you got a letter in the mail saying a certain stock was going to go up at the end of the month, and then during the month it did go up, and the next month you received a letter from the same person saying a certain stock was going to go down, and sure enough, it did go down, and then the third month, you got another letter that said a certain stock was going to go up, and during that month, the stock did go up. And in the fourth month, you got another letter said a stock was going to go up, and sure enough, it did. And for 10 straight months, every month, this financial advisor sent you a letter that said a certain stock was going to go up or a certain stock was going to go down, and they got it right every single time. At the end of 10 months, you get a letter saying, will you invest a big amount with me? Because I'm really good. Most people will say yes. But what you don't see is that in the beginning, that financial advisor or that stockbroker sent out 10,240 letters. 5,120 said the stock was going to go up, and 5,120, an equal number, said it was going to go down. And at the end of that month, the stockbroker sent out the letter, but only to 5,120 who he got right. And this time, he sent out 2,560 letters that said the stock was going to go down, and 2,560 that said the second stock was going to go up. At the end of that month, there were 2,560 people that never heard from him again. And he sent letters to the 2,560 where they had gotten 2 right. And this time, he picked 1,280 to send letters saying the stock was going to go up, and 1,280 saying the stock was going to go down. And at the end of that month, he chose the 640 that he got right, or the 1,280 he got right, sent out 640 saying up, 640 going down. From 640, it was 320, and then from 320, it became 160, and from those 160 to 80, and from those 80 to 40, from those 40 to 20, and finally, he has 10 people that he was right 10 times on the button. And those 10 were excellent prospects. It's the classic called the Baltimore stockbroker. Fact is, nobody knows why it's called the Baltimore stockbroker. Nobody knows if there was a stockbroker that ever did it. Nobody knows if there was a stockbroker in Baltimore. But it is a classic problem, or a classic example. We live in an industry where you only see what the fund companies, the brokerage companies want you to see. You know, what's often missing is completely left out. New mutual funds are being launched every year, and mutual funds usually go through an incubation period. The mutual fund is launched, they have no investors, but they build a track record of a year or two. And then, if it's successful, they launch it to the public. And if it's not been successful, it just gets buried away. When I was first starting out as a stockbroker back in 1986, I had the incident where I inherited an account. When brokers leave one firm and go to another, the old accounts are passed out to new advisors, new stockbrokers, and you start calling those people because you're now their financial advisor, their stockbroker, unless they move the account. And I have one client that had invested $10,000 in a mutual fund. I inherited her account, and when I looked at the value of the account, it was worth about $8,000, and I don't remember the numbers off the top of my head, but it was about $8,000. At the same time, you have mutual fund wholesalers that come into financial advisor's office and they tell you about mutual funds and which ones you should be buying, where you should be placing client money. And there was a wholesaler that came into the office and he said, this mutual fund that this client had a 20% per year track record for a number of years. And I thought that was the mutual fund that this inherited client had. But I had to go out and I had to look it up. And sure enough, my client was down 20%, not up 20% per year. So I came in and I asked the question. And it turns out that her mutual fund had been merged into another mutual fund that had a better track record. But because her mutual fund was a bigger one, they kept that name and used the track record from the other mutual fund. You know, people talk about mutual fund ratios, expense ratios, but what they leave out, and there was a study done by Edlin, Evans, and Cadillac, showing that when you add the trading costs, the cash drag, and capital gains, actual fees are closer to 3%. That, over 3 years, will cut more than 50% of the return. But no one explains that. They just look at the expense ratio. You know, the fact is, mutual funds change dramatically from year to year. There was a study done by Gary Palmer, or there was a study done by Gary Porter, Jack Tiff's. They published it in the Financial Analyst Journal back in 2014. And they looked at 2,846 mutual funds established between 1996 and 2008, run by 1,825 managers. And they looked at how many managers were left after just 10 years. What they found was this: only 195 mutual fund managers lasted 10 years. By the end of year one, 19% were already gone. The performance was bad enough that 19%, one out of five, were gone. In the second year, another 19% were gone. So almost 2 out of every 5 fund managers had a track record of being gone in the first 2 years. The underperformance was that great. At the end of 3 years, another 17% were gone. Over half were gone in the first 3 years. Over half had underperformed and had been removed. And in the fourth year, another 12%. So 2/3 were done in the first 4 years. what that says is investing's a difficult business. It's not easy. And most of the mutual funds that are sold on a short-term basis. Buy this because it had a track record of this over the last 3 months or 6 months or a year. And it has a low expense ratio. I don't care about the expense ratio if I'm looking at a mutual fund, and I don't do mutual funds except in 401ks. I only care about the long-term track record. How have they done over 10 years? And is the manager the same at the end of 10 years as they were 10 years ago? That's what makes a difference. If you're doing mutual funds, that's what you should be looking at. And if you have a portfolio of $100,000 or more, you shouldn't be doing mutual funds at all. You can get much better returns by doing separately managed accounts or by being with Adams Financial Concepts. That's what I'd like to say. You can do much better than you can do with mutual funds. That wraps it up for today. Have a very good weekend, rest of the weekend, and I will be back next week with the answer about money. Until then, have a great week.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you'd like Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared in the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams, here on AM 1590. The Answer. The preceding program was sponsored by Adams Financial Concepts. The following program is sponsored by Adams Financial Concepts.